The book that changed my money mindset. The Psychology of Money by Morgan Housel. Welcome back to the channel. If you're new here, my name is Willis. I'm a chartered accountant. I've been working in the industry for 7 years and I've been studying all things accountancy, personal finance and money for the last 9 years. In this video, we're going to be talking about 11 lessons from The Psychology of Money by Morgan Housel. So overall, this is a great book. It's sold over 3 million copies worldwide now, and I can see why. Let's jump into it. Lesson number 1 is that everyone views money differently. So everyone's view on money is going to be different depending on their upbringing and their past experiences in life. If you were brought up in a household where your parents or your carers were always short of money or trying to save as much as they possibly can, then you're likely to have grown up with a scarcity mindset towards money. Whereas if you were born into a more affluent family, a richer family with more money available to do the things you wanted to do whenever you wanted to do them, then you're probably going to be viewing money as a more abundant resource and not something to really worry about at all. And the author really gives some great examples in the book around people who were born around the 1970s in America. Throughout their teens and early 20s, the stock market would have roared and increased tenfold. Therefore, someone with this life experience would likely see stocks as something that they should be investing in, as something that's always going to be going up. However, if you were born in the 1960s, you would have seen inflation cause prices to go up threefold throughout your teens and 20s, and so you may have developed more of a scarcity mindset and one where money should be saved and protected as much as possible. For me personally, my teen years were just after the global financial crisis in 2008, so this meant I was surrounded by a bit more of a scarcity mindset. However, I also witnessed rock bottom interest rates for many years on mortgages. And so the view that I may have grown up with is one where borrowing money is quite cheap and therefore should be done. Just because everybody's upbringings are different and everybody's viewpoints on money are different doesn't mean anyone is necessarily right or wrong. They just see the world based on their cumulative experiences to date. I think we've got to remember here that humans have been around for thousands of years and our monetary system is really very young. In the book, Morgan Housel talks about how dogs were domesticated 10,000 years ago, but the Roth IRA in the US is only 25 years old. And so everybody's viewpoint on money is really going to be different depending on how they interpret these new concepts that are coming out all the time in the financial world. Lesson number 2 from the book is learning when enough is enough. The author emphasizes here that to be happy, you don't necessarily need as much money as possible. You only need to have enough. One study showed that figure's around $75,000 or maybe up to $100,000 in today's money, adjusted for inflation. Of course, this is only general and it really depends where you live. If you lived in New York, then that figure is likely going to be higher. But if you live somewhere in a more developing country, then that figure would obviously be a lot lower. And the study says that any extra money above this $75,000 to $100,000 is really not going to incrementally increase your happiness much further. The book also contains some stories around some people doing crazy things just to get more money when they don't really need it. In the book, Morgan Housel tells the story of Rajat Gupta. Rajat was born very poor. However, he had a very successful career, but his greatest desire was to become a billionaire. And he basically partook in insider trading to try and get to that goal as quickly as he possibly could. Now, of course, insider trading is illegal and he ended up going to jail and sacrificed his entire reputation just in the pursuit of becoming a billionaire. And there's really a great quote in this book here from Warren Buffett that says, "To risk something you do have and do need for something you don't have and don't need is very foolish." It's hard in today's society, given the whole keeping up with the Joneses and social comparisons, to identify where your point where enough really is. But we do need to make a concerted effort to find the point for us personally where enough is considered to be. Otherwise, we'll be forever chasing more and more and more, and we'll never be truly satisfied or truly happy. Lesson number 3 from the book is compounding is king. There's a great quote which is often attributed to Albert Einstein, and it goes, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who does not pays it." And to really put the effects of compound interest into perspective, this chapter focuses quite heavily on Warren Buffett and how he accumulated his wealth. There's an interesting stat within this chapter where it says that at the time of writing, $81.5 billion of Warren Buffett's then $84.5 billion net worth came after his 65th birthday. Now, this is clearly quite absurd, and the human mind is not necessarily built to deal with such mathematical absurdities. But we've got to bear in mind here that Warren Buffett has been investing since he was 10 years old and is still going into his 90s. So his results have been compounding over an 80-year period, and this is the power of compounding returns and interest. The book also has an example of 2 different individuals. We'll call them Jack and Jill for the purpose of this exercise. So Jack and Jill earn roughly the same amount of money. They invest roughly the same proportion of that money into the stock market over roughly the same time period. Let's say 30 years in this case. However, the key difference is that Jack consistently invested in the stock market throughout his life, throughout the years, through thick and thin, recession, boom, and never pulled out any of his money from his investments. Jill, on the other hand, was consistently trying to time the market. Now, what this means is she was selling out just before a recession started or a bust, and trying to buy before a boom took off. The result of this was that Jack's returns looked something like this, whereas Jill's returns were more mediocre and looked something more like this. Now we can see here that Jack's returns are much more favourable, and this is because he stayed the course throughout the decades and never tried to time the market, which is incredibly hard to do, and it's basically gambling. And there's another great quote later in the book from Charlie Munger, and he says, "The first rule of compounding is to never interrupt it unnecessarily," which is exactly what Jill was doing when she was taking cash out of her investments and trying to time the market. Jack, on the other hand, he benefited from the full compounding effect of leaving his investments in the stock market for the long run, and he benefited greatly. And compounding returns are relevant in other areas of life too. Like, think about technological advances in the last few decades. It was only 120 years ago that we human beings invented the aeroplane. However, now you and I can walk around with a fully functional computer, speak to pretty much anyone in the world, and find out anything we want to in seconds from this computer that can fit in our pocket and is the size of the palm of our hand. This is the effect of cumulative knowledge, cumulative innovation, and compounding results over time that has led to such fast technological development in the world. Lesson 4 is to save money, even for no reason. The author really emphasizes here that it's important to save money, even if you're not necessarily saving up for any one thing in particular. You don't have to be saving for a house or a car or a dream holiday. And he talks about here how anything that you buy above your basic living needs is really just your ego. So of course you can't necessarily control what return on your investments you get, or to an extent how much money you earn, but you can control how much of your money you save. Saving consistently will lead to a build-up of savings over time and a large emergency fund, which will give you more freedom and more peace of mind. We'll talk more about freedom in lesson 6. The author also makes a great point here around not tying yourself to a job in the future, because your lifestyle that you've built up over time, spending more than what you're making and not saving any money at all, requires you to have a certain level of income just to meet your basic living needs. Lesson number 5 is that you can be wrong a lot of the time and still win big. And I think this really comes down to the 80-20 principle. Now, if you're not familiar with the 80-20 principle, it essentially says that 80% of your returns or your results come from 20% of your efforts or your investments. Interestingly, going back to Charlie Munger again, he said that most of Berkshire Hathaway's investments have turned out to be pretty average and pretty mediocre. It was only a very few investments that really took off and made the company into what it is today. And the book says how venture capital as an industry is really built on this framework. A venture capital firm might make 50 investments. They'd expect half of them to fail. They'd expect 10 of them maybe to do okay, but they'd really only expect 1 or 2 of those investments to really take off and do fantastic returns. There's another great quote from Peter Lynch, who's considered one of the greatest investors of this generation. He says, "If you're good at this business, i.e. investing in the stock market and picking up individual stocks," he says, "you'll be right 6 out of 10 times, which in any other field wouldn't really be considered an exceptional return." And this is also why index funds are so good, because there are lots of companies in the index which won't perform well and may see average returns. However, the overall return of the index itself will be propped up by a few exceptional companies that have had exceptional returns throughout the year. And so you, as an investor, would get to benefit from that because you hold an investment in the index as a whole rather than the individual companies. Lesson number 6. Freedom will make you the happiest. The author refers here to freedom as the highest dividend that money can pay. There's also been a study conducted by Angus Campbell, who was a psychologist in the 20th century, which found that the ability to control your life and do what you want to do on a day-to-day basis is by far the single greatest contributor to someone's happiness. And if we think about the world today, wealth has increased very substantially over the last 100 years or so. Everyone has a lot more money than they did 100 years ago. However, so have working hours. And this is especially prevalent in the knowledge working industry, so more of the corporate sector, because people can't really ever go home from work because their jobs are based on knowledge and decision making and thinking and creativity. And so all the decisions relating to work, all the theories relating to work, all the thoughts relating to work are always in someone's mind, even when they go home from the office. This wasn't really a problem in previous generations because most jobs were manual labour, and obviously you can't build a car if you're not in the factory. And this is why so many people start businesses, not necessarily for the money, but for the freedom that they can get through starting their own business to choose what they do on a day-to-day basis. And of course they say money can't buy happiness. However, money can allow you a sense of freedom, which, as we've just discussed, can increase your happiness because it can buy back your time and control over what you do on a daily basis. And you don't necessarily have to be financially free to experience a sense of freedom. Even just saving up a large emergency fund over a period of time may allow you to take a year off work or potentially lose your job and have enough saved up that you can cover your basic living needs for at least 1 year, would still give you a sense of freedom. Lesson number 7 is to not be flashy with your money. There's a great quote that starts this chapter. It goes, "Spending your money to impress others and show them how much money you have is the fastest way to have less money." And I think this is a great quote because many people spend more than what they earn just to portray the image that they're rich. However, the author really emphasizes here that wealth is what you can't see. Wealth is what's in the bank. Wealth is properties owned. Wealth is investments owned. Things that you can't see just by looking at someone. He also mentions that nobody looks at the driver of a nice car. All they do is look at the car itself, not the driver. And so nobody else is actually as impressed with your fancy cars or your fancy belongings as you are. So it's important to start developing a mindset where you don't necessarily care what others think. And of course, this is hard in today's hyper socially conditioned and social media world where appearance seems to be everything. But if you're able to develop this mindset, then you'll never find yourself buying something just to impress somebody else, even if you don't want the thing yourself anyway. And the author mentions here that there are two sides to the wealth equation. There's earning and there's saving. He mentions that most people put a lot of effort into the earning side. However, most people don't put much effort or anywhere near enough effort into the saving side. And this doesn't really make sense because your earning capacity, if you're in a job, is often limited by your employer. And as we've discussed earlier, it's quite hard to really control how much you earn. However, you have complete control over how much you save outside of your basic living costs. It's important to work hard to save and invest for the future and not just work hard on increasing your earning capacity. And I think a lot of people here are subject to lifestyle inflation, which is the theory that as you earn more money, you end up spending more money because you can. But if over time you're able to increase your earning capacity but still keep your spending at the same sort of level, then you'll be able to save and invest substantially more over time than if you just ended up spending more because you could. And finally, in this section, he talks about people wanting to buy respect and admiration, and these are two things that really can't be bought. The way to have people respect and admire you is more to do with who you are as a person and how you act, rather than what fancy car you drive, what handbags you own, or what clothes you wear. Lesson number 8, you must always have a margin of safety. In life, there's always going to be surprises. There may be an unexpected medical bill, a broken boiler, a broken down car, or your investments may not return as much as you're expecting. In order to be prepared for this in advance, we need to have what's called a margin of safety, also known as room for error. For most people working in a job, this is likely to be their emergency fund, which is a pile of cash set aside over a period of time that they can use in the event of an emergency, such as a one-off large expense that's unexpected, or losing a job. In this chapter, the author also talks about learning from history. Now, people try and learn from history. However, they fail to realize that history is actually littered with first times. Think about the dot-com bubble, or the global financial crisis, or the Great Depression. These were all first-time events that had never really been seen before. And so it's important to not rely on past performance to predict future performance, because you simply can't predict the one-off unexpected events that are going to happen. For example, the stock market has returned, let's say, 10% cumulatively over the past 50 years. And so you might think on the face of it that the stock market is a very safe place to put your money for retirement. However, what if over the next 50 years it doesn't return that level anymore and it remains relatively flat? So if you're 30 now and you invest for 50 years in the stock market, by the time you're 80, you'd expect to have a large sum of money waiting for you in retirement. However, if the market has remained relatively flat throughout the entire 50-year period, then the value of your investments are going to be substantially lower than what you're expecting. We also need to be careful with over-mortgaging on property purchases. If you purchase a home and you have an 80% mortgage on it, so 80% of the value of the home is funded by the bank, and the value of the underlying asset, being the house, drops by 30%, which it could, then at this point you're going to owe more to the bank on the mortgage for the property than the actual underlying property itself is worth. So you need to think about that eventuality before you went into the purchase. Can you afford to repay the loan if the value of the property actually dropped below the value of that loan? And also think about the monthly repayments on a mortgage. What if interest rates go up substantially like they have done recently in the last couple of years? Could you still afford to make those monthly repayments? When you're setting out your financial plan, it's important to think about what could go wrong here. Lesson number 9 is thinking about falls in the value of your investments as fees rather than fines. Now, what the author means by this is fines are things to be avoided at all costs. If you receive a parking fine, the next logical thing to do is to try and not receive a parking fine again in the future. However, if there's something you want to participate in and there's a fee involved, you're generally just going to pay that fee to participate and not really think about it too much. He introduces a concept here which I think is really interesting, how when the value of your investment portfolio drops, viewing that as a fee to participate in greater future returns than a fine, and therefore a reason to pull your money out of the investment. And I think this is a really interesting way of looking at it and really managing your psychology here around peaks and troughs, because the market is most likely going to go up and down over the next few decades, as it has done in the past. And we need to be psychologically prepared when we're making investments in this type of asset for those periods where it drops in value. And thinking about it in this way, as a fee rather than a fine, I think is a great way to think about it. Lesson number 10. everyone is playing a different game. One thing that we have to be mindful of in the world of money is that everyone is playing a different game. Everyone has different goals, everyone has different aspirations. And in the book, they use the example of a day trader. So a day trader will buy a stock at the start of the day with the intention of selling it by lunchtime or latest the end of the day when hopefully it's gone up in value. If everyone's doing this technique, it's going to cause the value of that stock to keep going up and up and up. And those day traders will make money. However, if your objective is to save for retirement and build a strong financial base over a number of decades, then purchasing stocks that are going up in value because day traders are buying them and selling them on a regular basis may not be the right action to further the value of your portfolio. This also goes for people's buying habits for material items as well. Just because you see someone buying lots of clothes, going on lots of vacations, driving a fancy car, doesn't necessarily mean you need to. Everyone will have their own goals and aspirations in life, and the way they purchase material items may be in pursuit of their goals. What we really need to focus on here is not what other people are buying, but it's to understand what game we're playing. Are we aiming to enhance our image because we think it will further our career? Or are we aiming for freedom? Those two scenarios will result in two very different spending patterns. So it's important here just to not get distracted by other people's spending habits and really focus on your own game. What are your goals? What are your aspirations? And adjust your spending habits accordingly. And lesson number 11, the final lesson we're going to cover, is people love pessimism. This is one of the final chapters in the book, and I think it's very true. Think about it. A small fall in the stock market will be presented on the front of a newspaper or a news site in big bold letters, and it will be the biggest story of the day. However, a small increase in the stock market would only be reported quickly, and then the reporter would move on to something more pessimistic and negative. So it's important for us to not really get sucked into this. It's important to know what your goals are, what your aspirations are, and stick to those goals and aspirations and make decisions that move you further towards those goals and aspirations, rather than listening to all the external noise from everybody else. So remember, don't get sucked into the pessimism, stick to your goals, and don't just follow the crowd for the sake of it. So they were 11 lessons from the fantastic book, The Psychology of Money by Morgan Housel. I hope you've enjoyed this video and got some value out of it. If you have, please let me know in the comment section below what your favourite lesson was, if you think there's any lessons that I may have missed, and let me know if you read the book too. There's also a link in the description for my completely free expenses template and monthly tracker, so go and check it out. And as always, if you got some value out of the video, don't forget to drop it a like and subscribe to the channel.